All right, let's jump right into this. Welcome to today's Explainer, where we're tackling one of the most fascinating paradoxes in the market right now. We are looking at Alphabet, a company that is quite literally at a crossroads today. On one hand, you have this tech giant that is just firing on all cylinders operationally. But on the other hand, the market is severely punishing it for a massive AI spending spree. It's one of those situations that has a lot of people scratching their heads. So, what does this all mean? That brings us to the ultimate question we need to answer today. Are we looking at a once-in-a-decade buying opportunity, or is this a classic value trap? I want you to keep this question in the back of your mind as we go through the data, because the stakes here are incredibly high. We're talking about a scenario where a company can somehow grow its revenues by a massive 24%, and yet still face an absolute wall of market anxiety. Kind of seems contradictory, right? Here's how we're going to break this all down today. We'll start with Alphabet at a crossroads, look at their humming growth engine, and then tackle the AI spending dilemma. After that, we'll dive into the technical breakdown, look at real-time risks, and wrap up with the bottom line.
Okay, part one, Alphabet at a crossroads. Basically, a tale of two companies.
Right now, there is this massive cognitive dissonance happening between what Alphabet's underlying business is actually doing and how the stock market is reacting to it. Just get a load of these numbers. In Q2 of 2026, Alphabet's revenue hit $120 billion. That is up 24% year over year. And the really crucial point here is that this isn't some lucky one-off quarter. No, this marks their third consecutive quarter of accelerating growth. So we are absolutely not looking at a distressed company. This is a highly profitable machine. Moving right along to section 2, the growth engine hums. And man, is it firing on all cylinders. To really get why the core business is stronger than ever, you gotta look under the hood at where that 24% growth is actually coming from. Google Cloud, up an unbelievable 82%. I mean, let that sink in for a second. That is growing way faster than AWS or Azure at comparable stages. And why? Because enterprise clients are literally lining up for Google's AI infrastructure. They've got this massive cost advantage with their custom TPU chips that competitors are just scrambling to replicate. And meanwhile, the traditional cash cows are still doing incredibly well. YouTube is growing at 18% and search is up 15%. So that whole narrative about advertising dying out, yeah, totally overblown. It's evolving, for sure, but Google remains the undisputed default. Which leads us directly to this beauty of a number right here, 32%. That's Alphabet's operating margin. It is remarkably healthy. Even with them pouring buckets of cash into new tech, the core advertising and cloud businesses are generating massive operating leverage. They are dominant, and they are incredibly profitable. But okay, we have to flip the coin now. Section 3, the AI spending dilemma. Time to talk about the elephant in the room. We've got to look at the bear case because this right here is exactly why Wall Street is sweating bullets. Look at this staggering figure. Alphabet has committed to spending anywhere between $195 and $205 billion in capital expenditures just for this year. To put that into perspective, last year they spent $132 billion, so they are ramping up hard. This unprecedented level of spending is putting so much pressure on their financials that it actually pushed their free cash flow into negative territory last quarter. Wall Street notoriously hates uncertainty, right? So throwing $200 billion at AI without a guaranteed, immediate return is creating some serious anxiety. And it really comes down to how you interpret all that cash going out the door. The two camps are fiercely divided. The bear case argues that Alphabet is simply spending way too much, way too fast, without any guaranteed short-term return on investment. It just feels reckless to them. But then the bull case steps in and counters that, hey, this is foundational infrastructure. Think of it like laying down the first national highways or building the power grid. Companies that underinvest in AI today are going to be completely irrelevant in 5 years. And it's also worth pointing out, Alphabet happens to have over $100 billion in cash sitting on their balance sheet to weather this storm. But honestly, the real fear on the street might not even be the dollar amount itself. It's about execution. Because there are some legitimate red flags popping up. For instance, the highly anticipated Gemini 3.5 Pro has been delayed, and we've seen the departure of some really pivotal AI leaders like Jeff Dean. To an investor, those aren't just minor hiccups. They suggest internal friction. It really makes you wonder, even if they do spend all $200 billion, can they actually execute? All right, let's see how this is playing out. Section 4. The technical breakdown, visualizing the drop. So how is all this execution anxiety actually hitting the stock? Well, $700 billion. That is the sheer scale of the market cap wipeout Alphabet has experienced recently. The stock peaked up near $390 back in May, and it has dropped all the way down to roughly $340 today. That's a 15% drop. Just wrap your head around that for a second. A $700 billion wipeout is larger than the total market capitalization of most companies in the S&P 500. That is how heavily the market is punishing this AI uncertainty. So let's break down exactly where the stock is technically. Right now, your first floor of support is sitting really tightly between $330 and $328. If the selling pressure pushes it through that, the next floor drops to $300 and then way down to $270, which is actually a huge level because it coincides with the 200-day moving average. On the flip side, looking up, there is strong resistance between $345 and $350. If the stock can manage to break out above $350, that would be your signal for a major trend reversal back to the upside.
But let's talk about valuation, because this is where things get super fascinating. If you exclude their massive pile of net cash, Alphabet is currently trading at roughly 18 times forward earnings. For a company that is growing its top-line revenue at 24%, that is historically dirt cheap. In fact, Morningstar estimates their fair value is actually $435, which implies the stock is currently trading at a massive 21% discount today.
Moving to Section 5, real-time risks to watch. The tangible threats. Now, look, a discount is only a bargain if the core business remains intact, right? So we have to be completely objective about the tangible threats that could actually justify the market's pessimistic pricing. These aren't just theoretical what-ifs, they are playing out right now. First up, regulatory headwinds. The US and EU antitrust cases are very real, and they could literally force structural changes to Google's whole business model. Second, AI competition. OpenAI and Microsoft are aggressively pushing forward. If Google's Gemini models continue to lag, that incredible 82% cloud growth could hit a brick wall. Third is margin compression. If this huge capital spending stays elevated while revenue growth starts to slow down, earnings are going to take a direct hit. And finally, management stability. Losing top executive talent at this critical juncture creates a whole lot of leadership uncertainty.
All right, let's wrap this all up. Section 6, the bottom line. The time horizon dilemma.
So how do we actually make sense of all this data? Ultimately, Alphabet presents a classic time horizon dilemma. Based on the analysis, here is a structured way to approach this. If you are a short-term investor looking for a smooth ride over the next 6 to 12 months, well, buckle up. You should expect intense volatility. Those spending fears just aren't going away tomorrow. However, step 1. If you have a 3 to 5 year time horizon, the risk-reward ratio here is highly attractive. You are essentially getting a high-quality, wildly profitable company at a major discount. Step 2. Think about phased accumulation. Instead of chasing the stock on the days it's green, use those technical support levels we discussed earlier, like that $330 range, to patiently buy on weakness.
I want to leave you with this one final thought to chew on. We've seen the 24% revenue growth, and we've seen the 15% drop in the stock price. So you have to ask yourself, is it possible that the market is currently pricing in an absolute worst-case scenario for Alphabet's AI execution? A scenario that simply won't actually happen? It's a high-stakes gamble. And watching how this whole infrastructure investment plays out is going to define the tech landscape for the next decade. Thanks for joining me on this explainer, and I'll catch you next time.